Aloha everyone, Joshua Hayes at bigwavetrading.com with another weekend video lesson for everyone. This one's going to be a bit different. I actually only have one quality, quote, quote, quality new long position for Monday. But truth be told, while it is canceling quality, it definitely is not a stock that I'm a huge fan of. I don't have a lot of conviction behind it. If we have time in this video lesson, we'll go through it. At the same time, Friday was an ugly session, but fortunately for me and members of Big Wave Trading, since we normally buy right and we're strict with our cut loss management, it wasn't a bad day at all. Now, that being said, I'm heading into Monday session with the heaviest cash level that I've had since this area right here, December 2nd and December 3rd, back here in the SPY. I believe I had right around 7% cash this day, quickly was soaked back up, and I've been fully invested ever since. Now, what was funny about Friday is that I actually came into Friday session with 4% cash on hand. That was quickly soaked up by new long positions and signals, and I was back to 0% cash on hand as the session started. But as we all know, what happened, we can go in, we'll just look at a 5-minute chart of the SPY. This is about the area when I got back to being 100% invested, and then the SPY sold off on coronavirus concerns due to my extremely tight and aggressive profit stop trailing management and sell stop trailing management. That session on Friday ended, and I have now 7% cash on hand moving into Monday. So now the question is, will I raise more during the next upcoming week, or will I not? So that's what this video is going to be about. It's going to be about the SPY, basically the IWM, also QQQ and DIA. And basically, I'm just going off the cuff here. I'm just going to go through my charts and show you what I see, what I believe is going to happen. But before I do that, I want to go over some bullet points from articles that I read this weekend and videos that I watched on Saturday, actually. This all happened on Saturday. This is Saturday afternoon on Maui that I'm making this video. All right, everyone. So what you're looking at here is basically the chat room window that I have over at my website. And one of the charts I saw on Saturday was this. And I'm glad that they posted this because I got sick of hearing about this being 1999 the past week. And this chart right here shows you it's nothing like 1999. This is the run from, I hate that it does that, October 8th, 1998 to the top in 2000, what the NASDAQ looked like. And it shows you today what it looks like from the low of December 2018. And this goes to show you that potentially there's a lot of potential upside ahead before we even remotely look like 1999. So I know that one of the greatest traders of all time made a statement that this reminds him of 1999, but I can tell you, just by comparing the NASDAQ from the 2018 lows, comparing the NASDAQ to the 1998 lows, and knowing what I know, and I posted about the IPO market, this is nothing like 1999, nothing at all. Once again, I posted that I showed a Market Watch article from 2014 that referenced that we were partying like 1999. I'm sorry, this is nothing like 1999. I remember 1999, and I posted earlier, out of those 550, I think about 50 to 100 of them had no sales, and about 1 or 2 only had profits. So it's a little bit different this time. They may not have profits this time around also, but the quality of the companies are a lot better. They've been around a lot longer. It's nothing like 1999. So I want you to think about this chart that you're seeing here, how much more potential upside that we have in the NASDAQ before we do get to look like 1999. And then once again, I want to reference some Shalvaco Capital charts from this weekend. So I don't want to stop here long. You can pause the video lesson, and or what I recommend, go to Shalvaco Capital's YouTube videos and watch those videos. He posts them every weekend, and they are gold. Minimum investment to invest in Shalvaco Capital is $600,000. And I tell you what, a minimum investment for us to watch these videos might be $5,000 a year, but we're getting them for free. So please like, subscribe, follow everything that they do. These charts are theirs. They're not mine, but I want to show you them. So you can pause and read all of these on your own, okay? But I'm going to go through each one of these charts. And you'll see here, like on this little graph here, how the only one bad time out of 1, 2, 3, 4, 5 years was in 1998 that this certain signal right here happened. Now, they go in to show you that in 1998, this is what the ADX looked like. Gosh, I hate that that does that. But bottom line is the strengthening side was rolling over and the bearish line was curling up. This time we have the bearish line coming down, the strengthening line moving up. And to show you how different it is, this is what we look like from 1998 to 2019, only a 9.76% gain. This is during that same 22-year period. This is what we look like from 1976 to 1998, a 600% gain. A little different whenever you're looking at that 1 year. So here's another table that they showed of something that just happened. Short term, we should expect, possibly some negative months, but look at what happens 3, 4, 5 years from now. Then there's this. Granted, once again, the one bad case looks nothing like the rest of the cases via what the market has done via the preceding time frame. The bottom line is with all these charts is it shows we should expect good things to happen. And if you look at each and every single one of these tables, if you pause the recording and look at each of them and then think back and look back at that chart comparing our market now to how much further the NASDAQ could potentially need to go to become 1999, you'll see that things aren't as dire as some people say. And right here I'm showing the first green day of INND. They got Walmart.com news. This is an OTCBB stock. I love first big green days and OTCBBs on huge volume with the news catalyst. So we'll see if this one can't go up 500%, which is something that MZEIQ did intraday on Friday. So with all that being said, let's go ahead and get back to the overall market that I want to go over with everyone. So now we're back to an index chart of the overall market, and I want to look at the SPY. Now, I have a lot of different indicators that I look at. These are not the main ones here, basically, for the SPY. But what I want to show you is we've been trending above the 9 EMA and basically the 21 EMA the entire move off the September-October lows. We have the 9 EMA stacked on top of the 21 EMA, which is on top of the 50 SMA, 100 SMA, 200 SMA. This is bullish. Any pullback is buyable to any one of these levels as long as we then start to bounce and are in an uptrend. I also remind everybody on a weekly basis, there is no reason to think that a recession or bear market is around the corner until you trade below the 200 weekly moving average. You can see here at the end of 2018, we bounced off the weekly 200-day moving average. When did we not bounce off of it? When is it concerning to me? Well, here we got to go. It's a little bit wonky here. But you can see here in 2001, we get below the 200 weekly moving average. We try to pop back above it, but then we completely roll over and we stay below the 200 weekly moving average before we take it back. We do not get back below the 200 weekly moving average again until 2008. We rally back up, we fail at it. Now it's time to start getting worried. So for me, the number one key line in the sand for me before I get extremely bearish on the market is we need to be below the 200 weekly moving average. We need to then retest that moving average. And then once we failed, bad times can possibly be around the corner. Since 2008, the only time we flirted with that 200 weekly moving average was in 2011. We held it, we bounced, we rallied. We haven't even tested it again until 2018. So for everybody that thinks that we're heading into a bear market soon, we don't even have the very first thing that I look at, that 200 weekly moving average. We got to be below it. We can look for corrections. We can look for pullbacks. We can be bearish short term. But until that 200 weekly moving average or the 50 simple moving average on a monthly basis, you can see, once again, in 2001, we get below the 50 simple moving average on a monthly basis. We fail to get back above it. We sell off. We get below it here in 2008, and we just this time around, we just sell off. We don't even retest it. So as long as we're trending above the monthly 50 moving average, and as long as we're trending above the 200 weekly moving average, shouldn't even be thinking about a bear market. A correction? Sure. But any move and a bounce off this line, a pullback, a bounce off this line or this line, and I'm bullish. And even then, I love Fibonacci retracement levels. We can draw a Fibonacci retracement level here. All the way down to the 62 level is a solid support zone that we can look for bounces. We can then draw another Fibonacci retracement from here up to these highs, and we see we have more lines that we can use. So now we have all of these Fibonacci retracement levels from those two previous lows to high moves. We have this 200, 150 simple moving average. These are all support levels. And until we get below all of these levels, there is just no reason whatsoever to be bearish on this market. We get below, I'd say, this level right here, the June lows, then we can start to be concerned about the market. But we literally have all of those levels to work with before we get bearish. Now, short term, there are some issues. I'm going to switch over to this chart here since this has the MACD, RSI, and stochastics on it. You can see the stochastic short term has rolled over below the signal line. The RSI has done the same, and the MACD has done the same along with us below the 9 EMA. That means short term, yeah, we should expect more of a pullback. But that being said, let's look at the weekly index. How does that look? Stochastics is still overbought and is slowly rolling over, and so is RSI. But MACD is still strong, and on a monthly basis, everything looks good. Now, the one issue I do have with this market is, let me find my time segment volume. You probably got to go back to here. I'm going to go ahead and pin this over here. Move pane, I'm going to pin over here, and I'm going to bring up, if I can, there it is, my time segment volume. This has always been my bread and butter. Okay, so this is SPY with the time segment volume. I want to add the MACD. Let me add the MACD line, and I'm actually going to remove volume, so we just have these two lines. I have never been in an uptrend like we have right now, where my time segment volume on a monthly basis has been bearish for so long. We recently got a turn in the MACD on a monthly basis, and that confirmed the move higher, but time segment volume is still negative. So with this, using this as a guide, we're still not even in the quote-quote sweet spot for this uptrend cycle. You can see here, when the MACD is bullish on a monthly basis and time segment volume is bullish on a monthly basis, good things happen. But not only do good things happen, I push. If I get a beautiful individual stock setup, I push 5, 10, 15, 20% of my capital into it. And normally the minimum per trade is 2 to 5% per position when things are lined up. When we're choppy and we get signals, that's when I start to reduce size. When we're in a bear market, or a big downtrend, I don't get very many long signals. Like at the summer 2018 to the December lows, in the month of December, I was averaging 1 or 2 signals a day, went a full week without any signals. So we've gotten a lot of signals since this low in 2019, but because the time segment volume has been bearish the entire time, and because I've only received at most 5 stocks with quote-quote pretty beautiful charts, I have piecemealed together a completely invested portfolio using only 1% capital per trade. And the biggest reason for that is this negative time segment volume line. And folks, it just keeps getting worse. This is the monthly on the IWM. It's actually getting a little worse. The QQQ, it's getting a little worse in the most recent month. The DIA, not pretty at all. So guys, I've never quite seen a move up. Like, you look at this move here, okay? Even look at this move from 2016 to 2018. MACD confirms, time segment volume confirms. When we kind of go nowhere here on the DIA, MACD confirms, TSV confirms. This great uptrend here in 2013, which is where I got a lot of great signals and made a lot of money back in this 1 year period right here. Last time I can remember where I had really solid chart setups. Bullish, bullish. Compare that to now. We've turned, but we're nowhere near turning here. Once I get my time segment volume to curl and turn above the signal line, that's when then minimum size per trade is the 2%, average is 5%. I get a pretty beautiful hot setup. I'll put 20% of my capital into it. But if I don't have a lot of capital, there's not a lot I can do. And that's currently the situation I am in right now. So we're going over all of this because I hear a lot of people saying that this is the start of a new bear market. Maybe, but we're still a long way away before we can actually say that. The SPY does look toppy. This is the DIA, sorry. The SPY, very bearish engulfing candle on Friday. Engulfed the previous 1, 2, 3, 4, 5 sessions. That's never good. But as long as we're above the 21 EMA, the 50, 100, and 200 SMA, and overall on a monthly basis, that MACD is bullish. On a weekly basis, that MACD is bullish. Even the weekly basis on the TSV is bullish. So that's good. That always helps confirm. But I tell you what, if and when the MACD is bullish, the TSV is bullish on the monthly, then it's bullish on the weekly, and at the same time it's bullish on the daily, that's when you know to push, push, push with size in long positions. When the MACD and TSV is downtrending for me on the daily, downtrending on a weekly, and downtrending on a monthly, that's when you know you can push it to the bearish side. But I normally don't short stocks unless we're in a real bear market. And remember what a real bear market looks like for me. On a weekly basis, we're below the 200-day moving average, or simple moving average on a weekly basis. This is when I short sell the you-know-what out of stocks. But if we're only bearish on a weekly basis, and we're above the 200 weekly moving average, and we have time segment volume, MACD, negative like this, this is when I play SPY puts on a daily basis when there's entry signals given. SPY puts was my focus during this period. SPY puts has not been my focus the entire uptrend off the 2019 lows because we are above the 200, 100 simple moving average. There are long signals everywhere, and even though I'm only taking 1% per trade, they're all working. So until the long positions dry up, stop working, or I start to have like right now, the drawdown in my account is pretty big compared to the SPY. What the SPY, it says, is only, what is it down for the week? Is that changed for the week? From this high here to the low, the SPY is down around 1.5%. I actually have almost about a 4.5% drawdown in my account. That being said, I'm long some very high Momo names, and during this uptrend here, while the SPY is up around 5%, my end-of-day account, even with those 1% positions, is up well over 10%, so hence the drawdown. But the bottom line is, until the monthly MACD and TSV is bearish, and we're below at least the 21 EMA, until the weekly is below the 50 SMA minimum, and these are negative, and the daily is negative, there is no reason to be focused on SPY puts for huge, huge, huge longer-term moves. You should just be doing it intraday. So with all that being said, there is a minute left in this video. I want to go ahead then, since you dealt with all of that talk about the SPY. What does it all mean? What the hell was the point of this video lesson, you might be asking? The bottom line is, don't get too bearish just yet. Expect us to pull back. We should expect some consolidation from these overbought levels, but expect us to find a floor eventually around some of these lines and bounce. I'm not bearish. I'm looking to buy the pullbacks, and I won't stop looking to buy the pullbacks until the macro data weakens, and none of it looks bad yet. And then this is what I consider the micro data, the actual stocks. Macro data would be the GDP, CPI, new housing numbers, blah, 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 blah. Retail sales, blah, 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 blah. This is what I consider micro. Macro, micro, nothing confirms any of the bearish arguments I hear out there. So great, give me a pullback. I want to be a buyer. With that being said, what am I buying on Monday? We'll go ahead and go over it. All right, since you dealt with my rambling nonsense, it wasn't nonsense, it's actually very informative. I hope you guys are listening. I hope if you're bearish out there, listen, could this turn into a bear market in time? Sure. But to be bearish right now and not to look to buy the pullbacks is insane to me. And that's because, once again, if this was really bad market, wouldn't I be up to about 10, 20% cash? Because I'm always trailing stops higher. I only had, how many end of day sell signals did I have? 1, 2, 3, 4, 5, 6, 7 amongst the speculative and quality long positions. Here's the quality long positions on the end of day basis that failed. So you ready to see them really quick? WH. WH I got filled on this day. This was the first signal. This was the add signal. On the end, I'm already out. They've already ran my stops. I'm not in this stock anymore. Negative 3%. Ooh, what an ugly, ugly loss. XRX, already out. Ran all my stops. Trailed them higher this day. Hit 50% there, 100% there. I'm all out by Friday's session. But what's the loss on an end-of-day basis if you only trade it on an end-of-day basis? Once again, 3%. Ooh. And then the final one of quality, PLAB. This was the big one. This was the big fail right here. I went long up here, obviously, out of half of it when it goes here, out of another half when it trades below this low. By Friday, knocked completely out. My final stop was right here because once it lost green bop and went yellow, my final stop was here. When I initially went long, 50% here, 50% here. Once it loses that green bop, that's it. This stop gets raised to right here. Failed. What's the total damage on an end-of-day basis? Less than 10%. So, guys, that's not a sign of a market that's about ready to, you know what, the bed. So here's the one long signal I have of quality that doesn't have earnings coming up on Monday. TW. TW is CanSlim quality. It was in my price volume bop surge scan. And while it only has 1.4% of its float short, the reward risk ratio is amazing. Now here's how I see this, okay? Hammer candle over hammer candle price bar. On heavier above average volume, on increasing green bop, and you can see bop has steadily been increasing since it went over the zero line. So that's the signal. The price, bars, candle over candle, the volume, and the bop movement in accordance with the move of price. Now, here's what I look at to take a long signal. Minimum 3-to-1 reward to risk ratio. TW has it. If we just look and just do this part of the uptrend here, we're looking at a 16% gain. If we do this part of the uptrend here, we're looking at a 15% gain. If I'm wrong on TW, what do I lose at most using this as my final cut loss level? 2% with slippage. The game plan is for it to trade up and through 45.22. My stop, my good to cancel buy stop will be at 45.23. My good to cancel buy stop limit will be at 45.23. If the stock gaps up, I will not get filled and I will not call back on my order until it trades back below 45.22. If that happens, I will then call it back on. And 45.23 is my stop and is my limit. If I get filled, I got one level to work with. It's because it's splitting hairs with the other day. So you could do 50% of your stops at 44.49, 1 cent below the low of the day, and then do the other 50% at 44.33. I'll be doing it all at 44.33. So if you add in slippage, let's say that the worst that can happen, where is this at right here? Let's go here. Let's say that this is the worst that can happen. We are literally talking risking 2%, like I just said, for a potential minimum, let's say 15% gain. So what is that? 15 divided by 2. What's that turn out to be? 7-to-1 reward to risk ratio. Take it every day. So that's why TW is a new long. Do I love TW? No. Was it in my perfect speculator scan that's based off the book The Perfect Speculator by Brad Kodeshwar? No. Is the chart full of nothing but green and yellow bop? No. Is there only big, tall green volume bars in here? No. It's just simply a good reward to risk ratio. That's why I'm not putting 20% of my account into it, 15, 10, 5%. Just one. Just testing the waters. We'll see if it works. All right, everybody. My God, I tried to make this video less than 15 minutes long. It's impossible. I just can talk about this shit. I did it. Tried not to curse this entire video lesson. Made it to the very end. But technically, I could keep talking for about another hour. We can look at all the different oscillators. We didn't even look at the PPO. All right, everybody, if you could do me a favor, I would really appreciate it. Smash that like button, subscribe, ring the bell. Please leave me some comments. If you think I'm making these video lessons too long like I do, let me know. Tell me to shut my mouth, wrap it up. Nobody wants to watch a 30-minute video lesson. I get it. I can barely do it, but I do it all the time. That's all I watch, it seems like. Every video lesson I watch on YouTube is in between 20 and 30 minutes, so I seem to be right around there. But I do realize it's long. I'll try my best, guys. But like I said, I love this. And if you love it too, come join me at bigwavetrading.com. On my website, I offer a 2-week free trial. Check it out. Look at all the hard work I put into it. Tell you what, I tell you what I'm buying before I even send in my orders. I tell you what I'm buying the next morning. I tell you where my stop and limit is. And if I get filled, I tell you where my good to cancel sell stops are. You literally you could send in your orders and front run me on every trade idea. And let's say that there's 10 long signals in a day. I still tell you which ones are my favorite, which ones are my priority, which ones you should focus on. But just because I find one to be priority or one to focus on doesn't mean that you might not like what's number 10 on my list. You might know something about that signal that I don't like that much, and that may cause you to buy it. My job is to bring it to your attention, to let you know what I'm doing. You guys then take the reins and do with it what you want to do. All right, everybody. I'll see you in the next freemium video lesson. Aloha.